Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to episode 56 of the Capital Mind podcast. In today's episode, we discuss the investment landscape in India in light of higher interest rates, both here and abroad, especially given that rates abroad seem geared to go even higher. In this episode, we discuss how to play the debt opportunity and invest with the interest rate cycle in mind, which stocks counterintuitively do well in a high interest rate environment. Is there an opportunity in gold? What's the opportunity in real estate? How startup investing is likely to be impacted? Thoughts on how long high interest rate regimes last and when to know if this one has peaked? And finally, how a relatively stable India might respond to foreign central banks raising their rates. Deepak, if you were a retail investor in the US for the last 10 years, or say from 2010 to 2020, your universe was basically stocks or nothing, or maybe stocks and cryptos or nothing, because fixed income and debt, it just felt completely useless. I mean, I have friends over there as well, and there is essentially zero yield to be gained over there. So there's just no point even thinking of it as an asset class, at least as a retail investor. And to some extent, I felt that way in India for the last couple of years as well. I mean, I think maybe coming out of COVID or so, rates didn't feel all that high. At one point, it was almost not worth it to convert a savings account into a fixed deposit because the delta on that was just so trivial. And my memory is still fresh from how we used to all think of these Franklin Templeton ultra short debt funds as a great way of investing in debt. What was it, 9% with better taxation? But then when that blew up, the lesson I learned was, I guess debt is not the place you go to make good returns. Think of it as the steady part of your portfolio, or your inflation hedge, or your timing component. But I feel that's changing once again. I mean, as interest rates worldwide are rising, in India, the fixed deposit rates don't look so terrible anymore. Government debt rates aren't too shabby either. And I felt there's a bit of a revival of interest going on here. Now, of course, I'm speaking from an ignorant retail investor point of view. I know debt markets globally are always significantly larger than equity markets. But I guess I'll just come to you with this question. Does debt matter once again? Or should it have mattered all along to me as a retail customer and I was just being silly? So take it away.
Very interesting question, Shray. In fact, if you look at the bond markets over a long period of time, they have always had more assets. They've had much more money. They have had a lot more players interested because it was fixed income and it was more like guaranteed-ish sort of fixed income. The change that has happened in the last 10 years is probably unprecedented in terms of a longish period of really low interest rates in the West. But despite that, and this is a very interesting point. So there was a New York Times story that talked about how long-term, in a very long term, say 20 years, between 2000 and 2020, you got a 5.4% annualized return on the S&P 500. And long-term treasury bonds actually yielded more than 8%. So you got a 20-year period when US bonds beat US stocks at a time when the interest rates were very low. And perhaps that's the reason, because when the interest rates start off very high and they end very low, the capital appreciation on long-term bonds is so high that it kind of gives you equity level returns. And equities, on the other hand, go through cycles of ups and downs. And perhaps when we chose 2020 as a time frame, that was a time when COVID had ravaged, stock markets. And stock markets were down 25-30%. And so even though they had recovered about maybe 5 or 10% from the bottom, we were still down about, say, 15-16% from the top. And that kind of gave us a lower equity return. The same thing in India. If you look at 2020, roughly the same time frame, we're talking of a 10-year return in Indian corporate bond funds of 9% plus on a 10-year period. This is the same time, where an equity flexi cap fund like a Kotak, which is one of the best performing flexi cap funds during this time, it's returned about 10.5, 10.6%. So 9.2% for a corporate bond fund, 10.6% for one of the best flexi cap funds. And a particular flexi cap fund called HDFC Flexi Cap, which used to be called HDFC Equity Fund, returned only 6%. So the same time frame, we're talking at 2009, 2010, HDFC Flexi Cap was one of the best funds. It was called HDFC Equity Fund, one of the best performing funds at the time. And yet, over a 10-year period, that fund underperformed their own HDFC corporate bond fund by roughly 3 percentage points per year average. This is insane, sounds like, because you're looking and saying, why shouldn't equities beat bonds over the long term? There are periods, because equities are volatile, that equities may not necessarily beat. And here's the difference. If you start off with a period of high interest rates and end at a period of low interest rates, most likely you're making the capital appreciation on the bonds through this time frame, and that's what's going to give you the maximum percentage returns. Or if you go through cycles of high and low interest rate periods, where a fund manager can actually balance the portfolio and change it to a point where your returns are higher. I'll give you an example. 2009, Indian rates were very low. 2020 also, Indian rates were very low. So we start from a low and ended at a low interest rate period. However, in the middle, 2013 on 2015 onwards, you had a high interest rate period. There were a couple of others as well. And I think there was 2015-16 where you had extremely low interest rates, and of course 2020 onwards, low interest rates. So if you have a multiple period of high and low interest rates, you might actually get very good returns on certain corporate bonds or even government bonds. In fact, what causes bonds to gain money? And if you look at just the theory, it's like this. If I am expecting the market to give me 6%, then for every 100 rupees that I put in, I want 6 rupees per year. If there's a bond paying me 10 rupees per year, that is more than I require. So I'm willing to pay more than 100 rupees for that bond. So roughly I'm willing to pay, let us say, 150 rupees for that bond. So if I'm getting a 10% yield on the bond, so a 10% coupon on the bond, I'm willing to pay 50% higher than the face value, because my expectation is not 10%, my expectation is 6%. Similarly, if I have a 2% bond, then I will pay substantially lesser, of the order of, what is roughly 6% of this thing is about, say, 30 to 35 rupees. So instead of paying 100 rupees for a bond, I'll pay 35 rupees for a bond that pays me only 2 rupees for the face value. Now, this is also interesting because we have seen the bond trade at 100. It's down to 35 now. This has happened in the US. In the US, you have seen the TLT, which is a 20-year US Treasury ETF, start off at $100 or $95 actually in 2006. Go all the way to $170 in 2020. And today it's back to 95. So a bond fund of the highest grade US Treasuries, which of course are 20 years in size, has actually lost 35% or more, about roughly 40% in the last 1.5 to 2 years. So you've seen a massive losing period and you've seen a massive winning period itself. So there are periods when debt is a useless investment, but it's coming to a point where debt might actually start to become an interesting investment simply because interest rates all over the world have gone up. And this is the time to not look backward, but to look forward and say, going forward, returns might actually be quite good from here. And we'll expand. I think as this podcast goes on, we'll actually see why the returns might actually go up. But the most important point to understand is we are no longer in a low interest rate period. We're in a period of higher interest rates. The only question we should ask ourselves now is the interest rate environment going to stabilize from here or go down or go up? That means, are you going to expect more interest rates going forward or less? And the answer to that question will tell you whether bonds are investable or not.
I'll just start with one reaction, which is that as with any point-to-point comparison, there's tremendous starting point or ending point biases. So yes, it's true. I guess as you said, that 20-year S&P versus Treasury bond comparison looked so unfavorable. But I think just 6 months later, it was a very different story. So just sort of calling that out. But I think your ending point was very helpful. That in the sense, the last decade in the US or Western markets was very weird. I mean, with central banks playing the role they did. As a retail customer, debt, they in a sense had deliberately made debt unattractive for me in this sense, and so I had to do other stuff with my money. But I get your point. But now, as you said, there's no point looking back. I mean, that's just for the learnings. So now, I mean, the main merit of today's discussion is looking forward. So maybe I'll ask you, given that we are at a, I guess, relatively high or nearing the top of the interest rate cycle, I mean, I guess you will expound on that. But so my question is, as of today, how would you think of debt versus equity? Or how would you think of things within debt? Like in equities, you look at sectors and so on. How do you analyze debt when you think of it that way?
That's an interesting point, because I think debt and equity are intrinsically related. Of course, not government debt, but government debt also in a quasi kind of way. Now, every time that government, so think of debt as, if you give me 100 rupees, I'm going to guarantee you that I'll give you a certain amount back. This is the highest level of secured debt, which is pretty much most of the debt in the world. If you're looking at it that way, then the issue becomes that if interest rates go up, the cost of servicing that loans go up. That means if I have taken a 100 crore loan and the interest rates reset from 5% to 6%, instead of paying 5 crores a year in interest, I have to pay 6 crores a year in interest. So that's 1 percentage point increase in interest rates. If it comes to a point where, let us say, this interest rate becomes 8%, and I am no longer able to make the interest payments happen, because it could be that I have a 25 crore asset base. I have actually taken a 100 crore loan on that 25 crore asset base to make my whole equity, I mean the amount of money available as 125, use that to generate returns. Now I was generating 8% returns. Your interest costs were only 5%. The remaining 3% was great for me. It was fantastic return on equity also. And it was also good enough for me to be able to pay all the bills and all that stuff after, and perhaps even invest for the future. But if interest rates have reached 8%, I earn 8% on my money. I get back, I have to pay the 8% entirely to the bank. How do I then pay for anything else? I could actually end up going bankrupt. I could actually not just end up going bankrupt. I could see that my debt is in such a bad situation that only with a massive infusion of equity can I be saved. Now, because everybody knows this, by this time my equity valuations, because of the stock markets and all that, have gone down. Now, in 2013, we saw this. Steel companies went bankrupt because steel companies are inherently leveraged to a large extent. They take up a lot of debt to set up plants and so on. The EBITDA valuations, or the realization per EBITDA, varies on based on the market. Therefore, you have a situation where it could be that the realized EBITDA per ton is just about equal to the interest cost per ton that you are paying for the loans that you have taken. In many of the cases in steel companies, this was the opposite. They were paying more. So therefore, they went bankrupt. And when they went bankrupt, the idea was the bankruptcy code came in right and then. These bankruptcy code put those companies into bankruptcy, by which time interest rates had come down. But now, because they have so much debt to service and no production because they've stopped their plants and so on, the steel companies then eventually had to give up themselves to another player that came in and said, listen, at a lower interest rate, I can take this company, and my EBITDA per ton has increased because the steel demand has increased. At the same time, interest rates also have gone down. So I could borrow money, pay back the current people who have lent to this company, take over the company, and then build a fantastic asset. That's what they've done. Tata Steel took over Bhushan Steel, for instance, and ArcelorMittal took on a bunch of companies and so on. This is actually where it becomes very interesting, because equity valuations were hammered down because debt rates became too high. The same thing happened in 2018. It was NBFCs this time. NBFCs couldn't borrow. Their borrowing rates went through the roof. So you saw it. ILFS go bankrupt. DHFL go bankrupt in 2019. So essentially, all of this causes stress on the equity markets, a higher interest rate regime. Now, a lot of companies in the US also, because US rates have gone from, I think, 0.25, 0.5% all the way to 3.54%. In fact, borrowing in the high yield market has crossed 10% also. This will result in a lot of these companies going bankrupt eventually. And the US bankruptcy law is very interesting. Pension funds, which essentially were not able to make the 8% or 7% yield that they wanted to make because interest rates had fallen to 2% or 1%. And what UK pension funds did was for every 100 pounds that they had received, they borrowed another 100 or 200 pounds at the current market rate or whatever the market rate was, and invested all of that into government bonds. Now, the government bond prices have fallen by 25 or 30%. The borrowing costs have gone up from 0.5% per year to maybe 4% per year. And you've got a problem where the pension funds now need more and more money to just service the fact that their bonds are yielding, because they bought it at 2% yields. They're still buying at 2%. They're still yielding only 2%. But they're on the borrowing side, they're paying 4%. You got UK funds that can be are likely to go bankrupt as well. So it's not just equities, but it could be people who otherwise invest in equities also that go bust. This is where it becomes, kind of interesting, because if you look back at the past, there was a period when something like this happened, the 1970s. Before 1970, there was the Bretton Woods Agreement. So the US dollar was linked to gold. In 1970, 71 or something, they removed that thing. And once they did, after a couple of years, there was a big oil embargo. And because of that, oil prices spiked. Inflation spiked as well. In 74, there was a massive recession because of this. And there were a bunch of companies called the Nifty 50. Very, very good companies, but trading at extremely high Ps. So whether it was a McDonald's or a Kodak, which of course no longer exists, but McDonald's does, and so is J&J and a bunch of other companies. They used to trade very high Ps before this. Once this inflation-led recession started, because people couldn't afford to spend and so on, you saw these prices of these funds fall, or these stocks fall 80% or more in the next 1.5 years. Despite the fact that inflation continued to be high, interest rates weren't actually very high, because they didn't realize that they should actually be raising interest rates very, very dramatically. So because of that, and because there was already a recession, they didn't raise interest rates. Inflation remained high. You had stagflation. After 5 years, you realize that you can't have high inflation because it just hurts economies. So Volcker comes in and essentially raises rates till he says, until I break the back of inflation. He keeps raising rates from 2% to 4 to 6, 8, 10, 11, 15, 16% as well. So he's actually raised rates to a point where the Fed funds rate was 16% and 10-year bonds were yielding 18, 19%. But even if you took 2 years after that recession, there was caused back-to-back recessions, even if you bought it after that, the return for just the next 3 years, because rates fell from 14 to 16% down to 7% by 1986. So if 1982 to 1984 you had bought bonds, by 1986 you would have more than doubled your money in the bond market, which is a super surprise, because you wouldn't have made money in the bond market for a long time. And suddenly you doubled your money in 2 years. You actually get equity level returns in bonds at such times. Now, if you have a 14% yield, that means in 2 years I make 28% from just the coupon. And then whatever bond price appreciation happens. So if my 100 rupee bond or $100 bond goes to $200 and I get $28 as a coupon, I've actually made $128 on my $100 investment in 2 years, which is definitely better than equity, as good as equity level returns. Now, does it make sense to invest in bonds versus equity? My answer to that is it's entirely dependent on the interest rate cycle. And if you think that the cycle, and we'll come to whether the cycle is turning, the cycle for the interest rate rising and falling is entirely dependent on inflation. If we're going to see inflation peak at some point, then we are actually going to see interest rates start to come down. That is the perfect time to buy. Because if interest rates start to come down and inflation starts to level off, I think that is the perfect time, because you're going to get equity level returns in debt during that time. But as interest rates keep going up, you're not going to make a whole lot of money. Now, this is very interesting also because US bonds have already crossed 4% in yields, and I think they will cross 5%. We will see UK bonds also go up quite dramatically. India, on the other hand, is probably the upper rate of its interest cycle because India's inflation is actually lower than the US, lower than the UK, lower than even the Europe. And also our interest rates don't need to be hiked quite dramatically right now. So if we actually see a taper in the RBI's thought processes that says, listen, we've raised rates a lot, maybe we'll do one more rate hike and that's it. That is when you might see that it's the right time to invest into the bond market from an equity perspective. But right now, there's another weird thing happening in India. You don't get any premium. So if you invest in a 2-year government bond, you get 7.2 to 7.3%. If you invest in a 10-year government bond, you get 7.45%. So the difference between the 2-year and the 10-year returns is very, very little. So you're not getting what is called a duration premium. At the same time, companies are far more risky than the government. We know that. But those companies are not even getting any form of credit risk premium, in the sense that if the government bonds are at 7.4% for 10 years, then the corporate bond should be at least 8.25, but they're actually at 7.65. In fact, HDFC's perpetual AT1 instruments, which are not even bonds, they are basically worse than equity, traded recently at 7.6 or 7.8%. You're basically betting that, there is only such a small risk in an HDFC's perpetual, which is worse than equity compared to the government bond of roughly the same duration. This is a problem because we haven't had a lot of defaults yet. When interest rates rise enough and they're starting to be defaults, that defaults can be in NBFCs, in retail, in corporate, or whatever it is, you're going to start seeing that the risk premium in Indian corporate bonds will increase, which means that India, even though our interest rate cycle may taper off, our problem is that the credit risk premium that we're not getting right now may suddenly start getting into the system. So you should perhaps avoid a lot of long-term corporate bond funds while we have or any credit risk fund of any sort, simply because these defaults are likely to come. But at the same time, today it appears that the risk premium for the longer-term durations is non-existent completely. So you'd actually be better off investing in 2 years. Now, remember then, of course, that bonds have only two ways of investing. You invest for accrual or you invest for duration. So there's a difference between the two. One is I buy a fixed deposit. I want the return of the fixed deposit every month. I'm going to hold the fixed deposit till maturity. So I don't care what happens in the middle. So it's like hold to maturity. So I'm buying something and I hold it for accrual. But what if I start saying that I actually want to play the fact that the government will actually reduce rates? So I was in the short-term bond till now, but the the RBI will actually reduce rates going forward. So I start buying longer-term bonds. This is where you get a tremendous amount of positive impact. The positive impact that we are going to see on government bonds is that the government bonds may remain at the same value. Corporate bonds may actually increase in size. The credit risk premium may come in. But when RBI starts to drop rates, the longer term bonds will, even if it says that it's not going to raise rates anymore, the longer term bonds will actually do better because, let me give you the rough example. A 10-year bond yielding 7% or a 10-year bond yielding 8%. The difference in price is as much as 6 to 7%. So one will trade at 112, one will trade at 107 or 105. The difference of 7 rupees is just the price of the bond that reflects the higher yield. A higher yield is 105 and the lower yield is 112. So you could see if the yields come down from 8% to 7%, you could see prices increase by 7%. The same thing will be a much smaller increase for something like a 2-year or 3-year bond. So you might actually want to position yourself at the outer end of the spectrum in government bonds when the RBI switches its stance. But until then, I think it's a waste of time because you might see interest rates go up substantially. We don't even know how long they'll go up. And and debt is a very boring instrument. What happens in the equity market in 10 days happens in 6 months in the bond market. It happens slowly over time. It's excruciatingly painful, and people rejoice over 1% returns. If I get a 1% extra return somewhere, I say fantastic. Versus in the stock market, you buy some companies, and then the next thing you know, just because of the surname of the person owning the stock, it's up 7%. So it's the difference in stock market is palpable over there. But I think the value in looking at a bond market as a equity-ish investment happens only at the time when interest rates start to come down.
I'm going to move to different asset classes for a little bit, and then we'll return to both bonds and perhaps what you've been hinting at along, which is how do we understand where we are in the interest rate cycle. But in an environment like today, is there an opportunity in gold? Because traditionally, I know we've done podcasts on it, but traditionally gold has been viewed as something that will behave a little differently during this time.
Amazingly, Shray, we got 15% drop in gold prices, or say 17% drop in gold prices, right when the US inflation has been as much as, how much is the number? I think now, right, it's about 8.4 or 8.5% per year. So it is not inflation that drives up gold prices. It's the fear of inflation that drives up gold prices. So that means when inflation is actually very high, people will believe that inflation should lower from here, because the government and the Fed and all of these guys are taking action. And because of that, gold is no longer attractive because inflation isn't coming ahead of us. If you had bought gold 5 years ago or 10 years ago, saying that, listen, the inflation is eventually going to come, and inflation actually eventually arrived, guess how much you made on that entire investment? Zero. In fact, negative 15%, because the gold was $2,000 in 2011, and it's to 1,680 rupees dollars today. In rupee terms, you've done better because the rupee has depreciated so much that you've actually made some money in a 10-year period using gold. So I don't think there's a great hedge against inflation. And because the hedge against fear of inflation, people don't believe that this level of inflation will continue for the future, which is why gold prices are coming down.
I think this is in line with what you've said before. Let's quickly focus on equity for a bit before, as we do our roundup of all the different asset classes. So what's the opportunity today in equity markets? Given that interest rates are high.
This is very interesting because so much about this space is counterintuitive. Look at what happened in 2009 onwards. You had QE and QE up the wazoo and zero interest rates and negative interest rates. And you'd imagine that in that kind of an environment, it would be the person who borrows money that makes the max. Because you could take $100 of your own, borrow another $500 from the market. That $500 comes at next to zero cost. So even if you make a smaller margin, you will actually make so much money as a return on equity that your leverage works in your favor and you make a tremendous amount of money. This has not been the case. The biggest companies in the world today, other than Tesla, are all companies which have zero debt, whether it's Apple, Google, Microsoft, Facebook. None of these guys have any debt. Now, why don't they have, or Apple has some debt, but it's like quasi because they have cash somewhere else and debt somewhere else and so on. But there is a tremendous amount of move towards no debt, to low debt companies. Now, why does this happen? This is a very interesting point of things, because when the world comes into money, they have to invest in something. If the fixed income investments in the world yield very little, they will invest that money into the startups, into equity markets and so on. So a lot of service revenue companies like Apple, Apple of course has hardware products, so it's a slightly different beast. But you got Amazon and Google and all that, which are largely service-based offerings. These companies tend to make more money over this period simply because money is very, very cheap. And because money is very, very cheap, it somehow has come about that people didn't spend a lot of money buying assets. Why would you build a company which is low on assets at a time when the interest rate environment is so favorable to you that owning those assets costs you next to nothing? So given this, the problem has been that certain other asset prices went up. So for instance, the reason you didn't want to own a lot of trucks because the prices of trucks may be still affordable, but the price of real estate on which to keep those trucks has gone up through the roof and so on. So having said that, the corollary to this is that if in a low interest rate environment, the biggest beneficiaries happen to be zero debt companies and service companies. In a high interest rate environment, it should be the beneficiaries of a high interest rate environment are companies with very high levels of debt and also those who, from an intuitive perspective, a company that has a higher level of debt, but whose competitors need the same level of debt, but cannot acquire that because they don't have enough weight in the or standing in the debt markets, is the company that tends to win. It's a little bit like the cigarette space. If you tell cigarette companies that they're not allowed to advertise, it's not the cigarette companies that are harmed. It is the fact that nobody else can get into the cigarette business because they can't advertise. They can't even let people know that they have gotten into the cigarette business. So the incumbents in the cigarette business simply just make a lot of money. And the same thing applies in a high interest rate environment. You got companies who have been borrowing debt. They have been able to service their debt. A new competitor that comes in always gets debt at a higher level and they can't compete. And therefore, your winners tend to be now companies that are traditional value companies who have a certain amount of debt and who kind of leverage themselves and so on. So your companies who have no debt, which are primarily service-based offerings, which, for instance, Google makes a lot of money from ads. Who puts the ads? The answer is, well, a lot of people, but including a lot of startups. Startups bid up the ads for a lot of keywords simply because they raise money from investors to grow very fast at in a very quick time. If interest rates are high, the startups are not getting funding for multiple reasons we'll come to, but they can't advertise. If they can't advertise, Google's going to lose revenue. And you're going to see Google, Facebook, Microsoft, Azure, for instance, or Amazon Web Services. All of these guys report that the numbers are coming down because the number of new startups that are able to harness or use AWS or something to the highest extreme are actually coming down. Number of startups who are putting ads into Google and Facebook are actually coming down. So this is where the service companies that made the best of a low interest rate environment will not be the ones that win in a high interest rate environment and so on. If you have high interest rates and you do a lot of capex, then you have a bigger problem because now you have to service that capex in a low demand environment on a higher interest rate. So let's say it cost me $100 to build a factory today. Now I am going in at a time when the real estate costs and the costs of commodities are very elevated. So I estimate the cost is about 100 crores. I go in and put 100 crores into this project. Tomorrow, because the Fed and the RBI and all of them are trying to control inflation, the cost of my raw materials comes down, which means cement comes down and steel comes down and so on. Because of that, eventually real estate prices also come down because people get desperate to, sell and so on. We'll come to that. But if real estate prices come down, my capex, which was based on buying real estate and then building something on top of it, and that something contained cement and steel, and I estimated $100 rupee cost on it, might actually cost only 75 rupees for my competitor to build it 1 year down the line when inflation is under control. Second, I build the factory, I put it up, I put my finished goods out for sale, but there's a recession going on because interest rates are very high. So now my cost of inventory has increased. My economics go for a toss. While my competitor can come in, start building a factory at 25 or 30% lesser than me, get his products out at a time when the recession is nearly over. So I am in complete deep water over here. So it's an interesting point where you're saying that doing capex during a time of high inflation may actually hurt you much more than you think. So high interest rates, not high inflation, high interest rates. And once you start seeing the drop in interest rates, then the person that does capex, that is the person that's going to succeed quite enormously. I think that is where the equity markets might actually throw in a lot of opportunities. Companies with high amounts of debt who don't have competition. We think talking about PSUs. Why are PSUs? But PSUs can raise debt. The fact that you're a PSU means everybody is willing to lend to you. So they have an inherent advantage. Why do you think they're doing so well suddenly? It's not because their fundamentals have changed. It's just that their competitive strengths have actually improved because of the high interest rates environment. And of course, the last bit that is a problem is, say, areas of financial services. The financial service area themselves, apart from the services sector, they might actually see a higher amount of defaults and issues with the retail population that's borrowing from them. And some of the trade dynamics might actually hurt them. So that is one of the problems where you might say growth could come down quite substantially. In fact, some of the NBFCs recently that have announced results actually talked about a relatively lower growth cycle. They're showing great results because today also they have borrowed in the past. That borrowing in the past is working for them because that's at a lower interest rate, and their customers are now paying higher and higher interest rates to service their loans. But eventually that's going to catch up as well. So as those rates go up, you're going to see that the normalization of those rates are going to hurt the financial services sector quite dramatically in the next 1 year.
Okay. Well, I mean, the certainly the takeaway that go for companies with high leverage is very counterintuitive. So we'll see how that one pans out. But I do sort of understand the logic, as you said. Let's shift to another asset class. Where does real estate stand in this?
So real estate is where I think the initial part of any inflationary environment is going to bump up the price of real estate. People are going to buy in panic because they think that they cannot survive without real estate and the prices will go up. Once you reach a point where interest rates also start to increase, that means mortgage affordability becomes a problem. To the US, for instance, mortgages were at 2.5 to 3% about a year back, and today they're about 7%. Which means a person paying a $12,000, I'm giving you an example of a very high-end mortgage, but you can rough the numbers out. The $12,000 per month mortgage is now $19,000 per month for the same thing, for the same house. If it's like say 2 or 3 million, or I don't know how much, I mean, the actual end value of the house was in this case, but you can imagine that the prices of servicing a mortgage has gone up by 60%. However, most interest rate mortgages in mortgage interest rates in the US are on a fixed rate basis. That means if I got it at 2% per year, I only pay 2% per year until the rest of the loan. Nobody can change that for me. It's not an adjustable rate. In 2007, most of the real estate loans were adjustable mortgages. So not most, well, about 33-34% of them were, which means that 1 out of 3 loans had a reset date where rates would go higher simply because you had stayed, so you're finished 2 years or 3 years into the loan. Now, given that most companies or most borrowers have only taken fixed rate loans, there is no reason for them to sell at all. There's no reason for them to say, I will refinance the house. So refinances go back to zero. And you end up with a situation where people aren't selling their houses, because typically when they sell their houses, they will sell it and buy another house. Now, if I buy another house for the same price, I have to pay 50% higher mortgage rates. Why would I do that? I just stay in my own house. So as long as I'm staying in my own house, I don't do a transaction. But at some point, the recession kicks in. The recession kicks in and gets people fired. Once they get fired, they lose their jobs. Once they lose their jobs, they say, well, I can't afford this mortgage anymore. Why don't I move out of this house and into a rental? The rental may cost marginally lesser, but it means the demand for rent increases, but the demand for housing comes down. This is the time when they might want to sell their house, or the borrower might actually take over, foreclose the house and try to sell it. This is the cycle at which interest rates will move, the way that real estate will move in an interest rate cycle. Typically takes 1 or 2 years, but now if you get to a point where people are losing jobs, only then will you see real estate prices correct. This is the same with India as well, because in India, we haven't yet started to lose jobs. We've seen high real estate prices. We've seen mortgage rates also go up. It used to be 6.5%, now it's 8.5%. So both real estate prices have gone up and house mortgage rates have gone up. So you come to a point where if I were a person borrowing money to buy a house, then I would only do it if it was affordable to me at this interest rate. But more importantly, if you're in the fixed income market, and remember, you can buy a mortgage pool, or you can buy into a fund that has a mortgage pool. You simply do not want to invest in a mortgage pool at all, because fixed rate mortgages have only one thing: people pay you on time, or they don't pay you at all. Or they don't pay you at all was not a problem till now. But when there's a recession, the chances of that happening are much, much higher. So I think you should be careful of buying mortgage-based assets, and, in a way also investing in real estate companies, investing in home loan lending companies at this point, because you may be getting stretched to breaking point. There's a much bigger problem in the US, where they don't have recourse to any other asset. If you default on your fixed rate loan, in most states, they can't go after you for anything else. That means even if you own a like a fancy Mercedes or a BMW, they can't touch it, because you can just give back the keys to the house and say, you guys recover whatever it is from those houses. Don't come to me for anything else. In India, it's different because people can go after you, but at scale, this becomes a political problem. So the chances that home lenders will grow tremendously from here is now going to get weaker and weaker and weaker as interest rates increase. So yeah, I think investing in mortgages or mortgage-based players is a bad idea.
I guess it's kind of on point that you're not very impressed by gold or real estate no matter what happens. But your logic, completely get that. Can we move to another one where we've actually already seen things happen? The startup ecosystem. One would think that now with the cost of capital going up and interest rates rising, they should be adversely affected. But is there anything counterintuitive here as well?
So it's quite interesting here, because the unfortunate problem of startups is that startups come from this concept of, I need capital to burn. Now, the initial part of things was this new technology. I have to invent this new technology and I have to take it to the world, and I need some money to just do that. People said, okay, let's do that, and they funded. This was easy even in a high interest rate environment, because you needed small amounts of money, but a finite amount of money after which the technology would pay for itself, whether it was an Intel or any of the semiconductor companies or some of the hardware companies or even early Microsoft. They only needed a certain amount of money in the initial part, and then they were, capital efficient businesses that were built over time. What happens in a startup today is a very different thing. They're saying, listen, we know that, we can't change the world just now, but if we showed them that they could use a phone and click something and a car would magically appear at their door and take them to wherever they wanted to go, and they just had to pay a low price, they will become so dependent on it that they will want it no matter how much we charge them. This was the construct of, say, an Uber, an Ola, or any of these guys. The idea then was to go to investors and say, I need bucket loads of money. It's not small amounts of money. I need it for a long time. I want to lose money. And after 10 years, magically, I will start making a lot of money. The problem with this argument is, A, you're going to be capital inefficient for 10 years. You're going to assume that nobody else is going to invent a new form of transportation that is in the middle more efficient than anything that you do. You're also going to assume that money is available at a cheap rate. Now, why do I say that? Because if you're to lose money for 10 years, somebody has to be patient enough for 10 years to keep that money. If that person has other avenues that yield 8-9%, they're looking at you and saying, listen, in a period of 10 years, I'm actually losing not just the amount of money I give you today, but more than that as a function of the 10 years of interest that I haven't received. Which means if I'm giving you $100, I'm actually giving you $220, because you'll start talking about returns to me only after 10 years. You will lose money for 10 years, and you'll probably want to raise more money from other people and therefore dilute my stake in the middle. This proposition works in a low interest rate environment. So I can go to you and say, listen, where else will you invest? Government bonds are 0.5%. You might as well give it to me, because this is not going to give you anything. But if the interest rates are 5 or 6 or 7 or 8%, you're suddenly looking at the pension funds. So, that's another part of the argument. But the VC funds themselves have a problem. The VC funds go and raise money from people who therefore have these as options. They can invest in safe government bonds and get to 0.50 or 1%, or they could invest in some of the startups. Now, the pension funds themselves are saying, shit, we have to somehow get 4 or 5% returns. How do we get it if the government bonds are only giving us 1%? Let me take 20% of my money or 10% of my money, put it into something that gives me a ridiculously high return. And it's a ridiculously high amount of risk as well. And when I do that, I will give these people money for 10 years. Let them lose money for 10 years. I don't care. I just need the money back after 10 years, but it needs to be 10x or 15x what I gave them. This would be fine, because my alternatives are, I need to make that excess return from 10% of my portfolio, because the rest of my portfolio is not yielding much. What if I told you, forget this 10%, put the whole money in government bonds and get 4%, 5% per year? Then you'll be like, why do I need to take that risk? I don't need to take that risk. So they will probably look at this and say, I don't want to make those high risk bets anymore at some point. They switch out. So what happens is the sources of funding for VCs come down. the forces of funding for pension funds also, because pension funds are like, listen, we have to guarantee a certain amount of pension or something like that. I will instead, invest in staid avenues rather than take a lot of risk. Go downstream and you suddenly find that the exits into an IPO market in a high interest rate environment, because stock markets have already come down, is very, very bleak. You're not going to find a lot of tech IPOs IPOing at a major rate. The same thing, then the concept applies to downwards. So if you start with the biggest companies not being able to go IPO, then it's the second or third biggest companies that are not able to raise funding because their VCs are struggling with raising capital. And remember, a lot of VC capital is not raised. It is more like, I have raised $500 million. Oh, fantastic. But this $500 million is not in my bank account.
It's like commitments.
It's a commitment.
Okay.
So the problem with the commitment-based thing is that if I have to go back to the guy in a high interest rate period and say, I want to draw down 50 million, the guy can literally say, listen, I'm legally bound to give you this money because I've signed a contract, but don't make me do this because this is not going to fly with... it's not going to make me look good in front of my pension fund board or trustees or something like that. You're in a situation where you may have actually raised money, but you haven't raised money. So this is another point of it. It hasn't yet played out. It plays out very, very slowly. But you'll end up with a point where only a few large companies who a lot of funds have already invested in will keep getting funding. And you'll get two things. One, funds, startups that will go bust because they need cash to survive and they haven't. And because their business models are not based on, give me a little bit of money, I'll make it big. I need globs and globs and globs of money. Only then will I make it big. That business model fails because of lack of capital. The second thing that happens is, because of this insane focus on growth, a lot of startups have cut corners. And when they've cut corners, they have done bad things, including bad corporate governance. Some of them have siphoned off money from whatever they've raised from their investors. And the investors have said, listen, as long as you give me a great return, I don't give a shit, So it's unsaid. Nobody likes to say it. Nobody says, steal my money. But as long as it was in the realm of, oh, you're giving me a 10x return anyway, what difference does it make? It was kind of like glossed over. Now they're coming to a point and saying, guys, you can't be doing this because we need to prove that we're getting great returns. If I discover a corporate governance problem, I am going to highlight it. And as we are seeing in the last 6 months, we've already seen issues of corporate governance come in startups. I think this is going to also increase and cause more damage to startup funding and governance universes before something else comes in and starts to fix it. I think some big names will fail, and perhaps the only way we can know that this crisis is actually over is when there is a big name that fails.
I have to say that's quite depressing. I was hoping you'd have something more counterintuitive to say there, but I take your point. Although I guess I'll take heart from the one point which you made is that, look, if you're doing something that's still innovative and perhaps doesn't require endless supplies of money to whatever play out your business model, that those companies will perhaps always do well.
I think that's also a key point, because isn't that what startup funding was supposed to do? You're supposed to say, listen, I don't need to drown my competition out by charging nothing for my services for so long that my competition goes out of business and people have only me as an alternative. I am actually going to build a viable business model from the technology I do, which has insane amounts of leverage. So once I get it to this workable shape, the next thing is just money flowing in. And you can see this with the company like, Figma, for instance. Massive returns on capital for a technology that was superb and insanely scalable and could be offered to anybody all over the world who were otherwise going to have to pay $1,000 for a Photoshop and so on, and leverage the nature of people doing things simultaneously across the globe. I could edit an image when a customer in, say, Bombay or even the New York might actually see me change the color and say, hey, I like this. Oh, I like that. And then, show it. This kind of collaborative thinking process is just hugely innovative. It is exactly what venture funding was built for. But of course, a company like Figma would have also not focused so much on profits because they didn't need to. a new Figma today would probably say, listen, I can't give everybody everything for free. A certain amount of it will have to be paid for. And therefore, their growth prospects will be a little bit lesser because they have to do that. But I think that's still an innovative thing that people will fund. I just don't know whether today's a time where an Uber-like model will ever get funded.
Interesting, you should bring that. That takes me to my next question. So, both a comment and a question at the same time. That look, the reason you would say that, VCs or investors behaved like this was also because interest rates were so low for so long. That gave them the ability to invest tens or hundreds of $1 million over a decade and create these new categories and drown out the competition. So anyway, that was one that in a sense they were also reacting to incentives, and perhaps these were the incentives central banks were trying to create. But I think, look, throughout this whole podcast, you've been highlighting that enter when you see the cycle turning and so on. So I think my next question is, how long do these high interest rate regimes last? I mean, do they take many years, or what does the crystal ball say?
So this is actually quite interesting because I think high interest rate regimes haven't lasted very long in the past. So we've seen something like 2 to 3 years in the past. So you saw 1979 to 1982. That was about the high interest rate cycle in the US. 1997 to 99 perhaps. 2005 to 2007. This was actually an interest rate hiking cycle, 2005 to 2007. So we're about 6 months into this cycle. Now, here's where I think it gets tricky. We've had a very long period of very, very low rates. Can that mean that we can have a longer period of high rates? The answer will come from how much damage there will be to the economy before the central banks blink. If the damage to the economy is too much, and they're all political players, remember, they will not be economic players per se, and inflation continues to remain high, a Fed might simply say, listen, we would rather let the economy not be so badly damaged and take the downside of inflation. So we get into this stagflationary universe, which is like the 70s, where high interest rates actually should have come much earlier in the process, but they came only towards the end and they became extremely high before they were controlled. So that's the only thing that I would say is a corollary to this. But otherwise, cycles last 2 to 3 years, and India is in a fantastic shape because we've seen so many of these high inflationary times that we have always managed to do very quick turnarounds in terms of beating down inflation through higher interest rates. And I think that's where our strength lies, is that within India, we might actually see a much smaller interest rate cycle. I think the US and UK and European interest rate cycle now may be a little bit longer than 2.5 years. But over time, the answer to this question will depend on whether the central banks blink before inflation comes down, or do they allow stagflation to happen?
I sort of have two questions to build off of that. The first is, okay, how will I know if the cycle is indeed turning and that the central banks have won in the battle against inflation? Will I just see inflation numbers dipping? That's one. And the second one you were saying is that India is relatively better off than the West. You can tackle this later, but if the global economy continues to raise interest rates and the Fed is raising interest rates, can India actually just stand by and not raise interest rates? I think that's another question.
That's two extremely good questions. I think first one is about how do you know the interest rate cycles are changing? The answer to that comes to the fact of two things. Firstly, interest rate cycles don't change overnight. They take a long time to change. So if you see a cycle changing, it's like watching paint dry. 6 months to 8 months, nothing will happen, and suddenly the cycle would have changed. That is how slow things are. So we don't need to act in a hurry. We can actually wait for a lot of data points to show us that the cycle is changing. And the second point, and perhaps more important, is it depends entirely on the trajectory of inflation. That means if inflation is starting to come down, we are going to see that interest rates will start to come down eventually. Now, it may not be immediate. So 1 or 2 months of low inflation may not prompt them to drop inflation. They might wait for 6 months. But if you see 2 or 3 months, you see the Fed or the RBI pausing rates rather than increasing rates, you might say that that's the point at which the interest rate cycle is turning. The prices of long-term bonds will start to go up even before this, which means long-term yields will fall. Now, remember, right now, already, 10-year yields in the US are, I think, 3.95% or 4%, and 2-year bond yields are 4.5%. So if you invest in something for 2 years, it's 4.5, but for 10 years, it's only 3.95 or 4. So already they feel that inflation within the next 10 years will start to see lower and lower interest rates, but within the next 2 years is going to be high. That, I think, is the key to answer to inflation, is how long does this 2-year yield remain at a very elevated rate. It is until the point where the Fed says we are nearly done, guys, just bear with us. I think inflation is done, and that's. But inflation in the US and inflation in India are very different beasts. Inflation in the US is driven mostly by owner's equivalent rent. So rents, the rental part of the ecosystem. And the second thing that the US hinges on is wages. So if wages don't go down and rents don't go down, don't expect inflation to go down. So if you want to see inflation come down, you should actually be seeing wages come down, which means unemployment increasing and so on. Or you should see owner's equivalent rent, not the housing prices, but the equivalent rent. Remember, I told you, like, even if people were forced to sell their houses, they're going to have to rent something else. So rents might remain a little more elevated for a longer time. But until rent prices come down and wages come down, you're not going to see a reprieve for inflation in the US. In India, it's entirely food and fuel. Food and fuel are probably 60-65% of our indexes. So if food prices come down, which they have or they will in the next few months because of a good winter and a good harvest and so on, and if fuel prices come down, which they have from the $120 down to $90 in crude, and maybe a little bit more in terms of the rupee equation right now. But I think India's inflation will come down just as a natural consequence. So we might see India talking a little more dovish a little before the Fed does. And coming to the second part, so why would India then stop raising if the US dollar? I think unfortunately the answer is, I hate to say this, but we are not going to be rational about this. We are not going to say India's inflation is lower, therefore we should reduce rates. We are going to be like, hey, look, the US is raising rates, so let's also raise rates.
Otherwise, dollar will go up.
Otherwise, dollar keeps going up. But that's not the answer. The problem is in India, investors from the US or from any part of the world, they don't invest in our debt markets. They invest in our equity markets. And when Indian rates go down, our equity markets are more attractive and therefore more money comes in. So in contrary to what people believe, it is actually the dollar losing value or rupee gaining value when we drop rates rather than when we increase rates. So I think rate increases have a value, that in the sense of they should be used to control inflation. Unfortunately, we will use it as an exchange rate controlling mechanism when we don't have the underlying infrastructure to create those exchange rate arbitrage dynamics that allow for this thing to happen. So you're right in that what we should be doing is probably independently assessing our rate requirements. But in reality, what we will do is we will just panic and keep rates high as long as the US rates are very high. But over time, even that will adjust itself. So unfortunately, for the next, as long as the US is in a recessionary kind of high interest rate cycle, we should not expect too much about the Indian rates going down dramatically. At best, I think we will actually plateau and not go down, not go up any further.
And I think my last question isn't really linked to the topic, but is, look, your conversation has been so optimistic. I mean, I understand that there's pain to come, all that. Until the cycle turns, you don't really have money to be made. Equity is unpredictable. But at no point have you expressed the fear that the world is going to hell or that everything's going to come apart. You're in fact playing, as they say, on the front foot, right? I mean, you're looking for opportunities and looking the cycle. So much has gone wrong. I mean, there's some non-zero risk of nuclear war, or Europe, there's still, I mean, just a month ago, we were talking about how they may potentially freeze in the winter or industry could come grinding to a halt. The US looks politically unstable. And China has not had a very good weekend either, as we know. So with all this uncertainty, how come at no point in this conversation are you sort of talking about catastrophe risk and so on? I mean, how are you still so optimistic?
So I think one of the problems that I have in my mind, actually, and say this, I mean, I may be completely wrong on this, is that if there is a nuclear war, we're all screwed anyway. So at some point, my feeling is that we should be able to fight this. We should be able to get over this, and somehow good will come out of it. At some point, that good will kind of feed into, because we are naturally, I mean, unless we're going back to living in caves, we are going to want to, at some point, end this battle. I mean, I don't think even Russia wants a nuclear winter, neither does Europe or anybody else. So at this point, all the belligerence is like this. There's this old Govinda and I don't know Chunky Pandey movies or something like that, where they would both look at each other and say "hey," but they would actually never fight each other. That's approximately how the world is like, because if you actually get into a fight in any meaningful way, you are going to destroy each other. It's mutually assured destruction, and nobody wants that. So I think this is the problem that I have when I think of the world as a catastrophe, is that we will not get into this mutually assured destruction phase. We will actually stay one step away. We will go to the absolute brink of disaster, but we will come back, which means it makes sense to kind of think of this as, because the future is so uncertain, stock market valuations are all screwed up and they're going up and down and left and right and center. Chinese stocks are falling like 9 pins because Xi made a statement saying private wealth is not a good thing. I understand where the communism thought process comes from, but I think of obviously disasters for stock markets, for at least Chinese stocks and stock markets. I think all of these statements are only made to a point where, for instance, tomorrow something happens to the extent where China needs external money and does not have it. Or that it no longer can be the provider to the world that it is right now, because other people have built up their own capabilities, or that there are alternative capability areas in the rest of the world, which would mean that China would have to bend down and say, well, you know what, let's talk. I think all of these aspects may happen over the next 2 or 3 years, but no matter what we do, I don't think the world is going to go to hell in a handbasket. It will appear like it will. And when it appears like it will, are the maximum opportunities of future potential. And maybe it's been so in the last week or so. America's stock markets have been going up 1% a day, almost unreasonably, because everything else looks like a disaster. Markets climb a wall of worry. And sometimes that wall of worry is what makes us feel that the world is going to hell on the other side. But the opportunities are actually available now in the market. So maybe that is the question that I have, is if you don't deploy in an uncertain world, when do you deploy? So maybe this is the time, and maybe this is the place, and whether it is debt or equity or real estate or gold. I think real estate or gold are crap, so I don't find them worthy of investments right now. But other than a very short-term thing, maybe momentum-ish in real estate. But other than that, I would say the biggest answer to long-term growth stories will be invest when times are uncertain, and great things will happen. And great things. And eventually, I hate to. As fund managers, we are obviously naturally biased, right? So when we come from Capital Mind, we're almost like, the world is rosy and look at these fancy sunglasses that have tints on them, and but I think intrinsically you have to be, because if there's no way you can easily bet and make the massive returns that you want on the bet that the world will come to an end. So the only bet has to be on the other side. It may take us towards the end, but from there it's going to give us great returns. So find the opportunity and then latch onto it when it comes. I think the opportunity may have presented itself in small pockets, but I think this is the time to keep your eye open for those opportunities, both in debt and in equities.
Thank you so much.
That was awesome. Thank you. Thanks, Ray.
Well, everyone, thanks for listening. If you like how Deepak and the Capital Mind team analyze markets and think about investing, visit capitalmindwealth.com to learn more about our portfolio management service, where we can manage your money for you at a very low cost. If you have any feedback, suggestions, or topics for our next episode, please send over an email to podcast@capitalmind.in.